Matt Capital attended the Bloomberg panel discussion yesterday covering the risks and diversification in the GCC. The panel included prominent business leaders and economists. Analysis included highlighting the difference between the Dubai government providing funding for Nikhil Sukuk and the government providing funding for the remaining debts of Dubai World, which are estimated to be between 22 and 23 billion US dollars. Discussion also revolved around the need for greater transparency and disclosure in Dubai government-related entities, the need for a Dubai sovereign bond rating, which it does not have at the moment, unlike peers around the GCC, and also greater emphasis on real regional diversification, utilising the UAE's competitive advantage in cheap petrochemical inputs, its role as a trade hub, and also low-cost labour is very abundant in the UAE. Health, education, manufacturing and services were all highlighted as industries that are very underpenetrated in the UAE and more specifically in Dubai at this point in time, which to me creates an opportunity going forward for new small and medium-sized companies to grow into these sectors and over time list on the local exchange. Discussion also touched on the relationship between Dubai and Abu Dhabi, and sometimes there is friction in that relationship, but in this case Abu Dhabi has come forward and provided the funds that Dubai needs. And indeed it was highlighted that Abu Dhabi owns a lot of the property around Dubai now and is involved in a lot of the business projects, so the relationship is a lot closer than what you would otherwise think. Discussion also talked about the role of a monetary union in the GCC and the fact that there are too many stock markets in the GCC, and it's likely that the volumes will consolidate towards the larger markets such as Dubai, where it has established investment infrastructure, greater general transparency and more liberalised environment for expatriate workers to live and do their jobs in. Consensus seems to be that the current credit market issues will steadily work through the banking system as non-performing loan and provisionings rise amongst domestic banks over the next 3 to 4 quarters. Please note that current loans outstanding for UAE banks are around 272 billion US dollars. So assuming that local banks owe around 4 to 5 billion dollars to Dubai World, in a worst case scenario, if 100% of this has to be written off, which is unlikely, this equates to 1.4% of total banking loan book, which would increase the non-performing loan ratio from around 2% to 3.4%, which is in line with emerging market standards. The key immediate term catalyst for local markets will be feedback from Dubai World creditors following the meeting on Monday, and then during the coming 1 to 2 quarters, details of how Dubai World intends to restructure its business, including disclosing which assets it has, so we can ascertain the quality of these assets and also the turnaround potential and the sale potential in international markets. Disclosure on the cash flow and financial position of other government-related entities such as Dubai Holdings is also likely to coincide with the Dubai government looking to instill more confidence in local credit markets. We see credit market stability as crucial. Dubai companies must be able to finance a greater proportion of their debt through bond and sukuk issuance as opposed to relying on bank debt, which relieves some of the pressure on local banks and also foreign banks, allowing them to lend less of their book to corporates and more to small to medium-sized enterprises, which is good for GDP growth in the UAE and also good for diversification. Although we believe that there is potentially bumpy waters ahead for DFM markets, the overall trend is likely to be upwards towards 2,100 in the medium term and then above this next year. Recent events are the first step of restructuring these economies and are no different to other events that have taken place in Europe and the US and other developed markets over the course of history. Investors can therefore seek to take advantage of the long-term growth in this region and also the cheaper equity prices by accumulating some of our preferred exposures at these lower prices and then trading in and out of the positions based on price appreciation. Early next year, investors will begin to focus on which companies are paying cash or stock dividends in March and April of 2010. We've picked out the companies which we believe will pay some kind of a dividend yield next year, whether it's cash or stock or both, and we believe that the share prices of these companies will appreciate during January and February as investors expect to receive a cash return. These companies include First Gulf Bank, 3% dividend yield, National Bank of Abu Dhabi, 2.4% dividend yield, Union National Bank, 4% yield, Air Arabia, 3% yield, Dubai Islamic Bank, potentially a 6% dividend yield, DFM, potentially 2.5%, and also Aramex and Agthia have the ability to pay a higher cash dividend out of earnings, although last year they did not choose to do this and therefore we did not have a precedent. Additionally, although DP World's forecast cash dividend yield is only 1.6%, because its owner Dubai World requires cash flow, it may ask DP World to pay out a higher dividend ratio, which would equate to a return to shareholders of up to 3% dividend yield. On balance, we believe that companies in the UAE will choose to pay a higher stock yield this year as opposed to a higher cash yield because earnings have decreased over the course of 2009. So that's all for this week. Happy investing, Merry Christmas, Alarica, and Sayonara!